The taxman's nightmare. Picture this, your cousin in Berlin, Clara, sends you a few $1,000s in crypto for your birthday. It's instant, digital, and feels like the future. No banks, no wires, no fees. But then you wonder, do I owe taxes on this? Suddenly, your borderless crypto dream crashes into the wall of international tax law. Is it a gift? Is it income? Does Germany care? Does the IRS care? Welcome to the global confusion party. This isn't just you and Clara. People everywhere are trading, earning, and sending crypto across borders, but the rules were made for a world of banks and shipping containers, not digital tokens. Crypto was built to be borderless, but tax authorities are all about borders. The IRS wants its cut. Germany wants its cut. When your transaction happens in digital no man's land, both might say, dibs. That simple birthday gift? It just opened a Pandora's box of questions. You're now tangled in a web of international regulations that can't keep up with the tech. The promise of crypto was freedom and simplicity. The reality? Paperwork, confusion, and the looming shadow of the taxman. And that's why we need to talk about the secret rulebook that governs all of this tax treaties. So, what are tax treaties? Think of them as financial friendship bracelets between countries. They're formal agreements to prevent double taxation, so you don't get taxed twice on the same income. For example, if you're a US citizen living in France, both countries might want to tax your income. Treaties set tiebreaker rules. Usually, the country where you live gets first dibs, and the other gives you credit for taxes paid. They cover all sorts of income, salaries, dividends, royalties, and more. Treaties define who counts as a resident, what counts as a business presence, and set tax rates for cross-border payments. For instance, a treaty might cap US tax on dividends paid to a Japanese investor at 10%, instead of 30%. These agreements create certainty for international business and prevent tax chaos. They're the reason companies can operate globally without endless tax nightmares. But here's the billion-dollar question. What happens when you introduce something like cryptocurrency, which these old rulebooks never imagined? This is where things get messy. Tax treaties talk about dividends, interest, and royalties, but what is crypto? If you stake crypto and earn rewards, is that interest? If you get an airdrop, is it a dividend or a gift? No one's sure. Let's go back to Clara's gift. The US-Germany treaty has rules for gifts, but the IRS treats crypto as property. When you sell it, you'll owe capital gains tax. If you're paid in crypto for freelance work, that's income. The treaty says the US can tax you, but it wasn't written for crypto's wild price swings. Which value do you report? The value when you're paid, or when you file taxes? Countries are trying to fit crypto into old boxes, but it doesn't always work. One country might call staking rewards interest, another calls it other income. This means you could be taxed by both countries on the same crypto earnings, the very problem treaties were meant to solve. Double taxation is back. The biggest challenge? No one agrees on what crypto is. Is it currency, property, a commodity, or a security? Every country has its own answer. If they can't agree on what it is, they can't agree on how to tax it. Tracking and reporting is another nightmare. No banks, no neat forms, just you and your messy transaction history. DAOs and decentralized projects break the old model of physical presence. Where is a DAO located? Everywhere and nowhere. And crypto evolves faster than regulators can keep up. By the time they update the rules, the technology has already changed. It's chaos, and the taxman is always a step behind. This isn't just a problem for crypto whales. If you ignore the rules, you're gambling with audits, penalties, and even criminal charges. Tax authorities are getting smarter, using blockchain analysis to track transactions. Compliance isn't just about avoiding trouble, it's about making crypto legitimate. Widespread tax evasion gives the industry a bad name and invites harsh regulations. For governments, there's billions in tax revenue at stake. If rules are too harsh, innovation and talent will leave for friendlier countries. Clear, fair rules build trust and let the crypto economy grow alongside the traditional one. This isn't crypto versus government. It's about finding a way to coexist. Everyone benefits from clarity and cooperation. So, what can you do? First, document everything, every transaction. Use crypto tax software. Don't try to do this by hand. Understand your taxable events, selling, trading, spending, earning rewards, all can trigger taxes. Get professional help. Find a tax pro who understands crypto and international rules. Yes, it costs money, but it can save you thousands in penalties. Stay informed. The rules are changing, but they're getting clearer. Organizations are working on global frameworks, and governments are issuing more guidance. Make a good faith effort to comply, keep good records, and consult a pro when in doubt. Be proactive and responsible, and you can enjoy crypto without fearing the taxman. Now go forth and be compliant.